What's up, guys? Wanted to do this video today for really, it's a basic real estate 101. If you're going to be buying multifamily real estate to invest, making money in multifamily real estate, there's a couple of things that you have to do when you're underwriting a deal. And there's a couple of points we're going to hit on them. But I'm doing this because number one, I want to help you guys make money and create wealth for you and your family using real estate. It's important. I created this channel for this reason to be able to help you with that. So that's why I wanted to share this with you guys and go over these couple of points. So number one thing when I'm underwriting a deal, I'm always looking for barriers to entry. Like that's why I like for example, I moved to San Diego from Hawaii. I loved Hawaii market. Why? Because on one side, you got the ocean. On the other side, you have some land. Really, you're in the middle of the island, right? But like that is a heavy barrier to entry. So barrier to entry could be like the ocean on one side, a lake, um, mountains, like the topography, like basically the environment. What keeps somebody from being able to get in there? That's the barrier to entry that market based on the real estate, right? Where things are. So like it could be other stuff too. Like for example, like San Diego, California, man, it costs a lot of money to build. Like your cost, like just your permits alone, like some of the stuff that we look at here to get a permit, just a paper, not build anything, could be anywhere from 75 to $100,000 to just pull a permit before you do anything, before a shovel hits the dirt to just get approval. That's a barrier to entry. It could be like where you are, you're constrained. You can't build more multifamily real estate in this area and they need housing, but they're allowing you to do something else. Those are also barriers to entry. So anytime you're looking at investing in a multifamily or any real estate market, you want to find out what are the barriers to entry. Barrier to entries are actually good. You can't just keep building like in Texas or Houston, where you can build a church next to an elementary school, next to a strip club, next to a liquor store. They can do kind of what they want because they have low what's it called? Like building stuff. Like when you're gonna do anything and you get building permits, like restrictions on building, they don't have a lot of that there. So you have a lot of like crazy areas that just pop up out of nowhere. Or like Austin, it's like rolling hills. You just go from Austin, Round Rock, Pflugerville, Bastrop. You can just keep on going. Like they have low barrier to entries, which is why some of those markets tend to keep having problems. All right. So next, I'm looking at always, and I just talked about this repair cost. I mean, replacement cost, right? I have below replacement cost right here and BLT, which is actually below, they're below last trade. I'll go over that in a minute. But anyways, I like to look at like what does it cost to replace something? Like if we can buy like one of the deals we looked at, I think this is a less than 10-year-old property downtown San Diego. It traded for like 375,000 a door, 300 units, beautiful property, great location, and it will cost somewhere between 700 to $900,000 per unit to rebuild that. That is crazy, but that's what's happening right now. There's a reason for it. But you want to look at a deal. Like, what does it cost to replace this property? If you had to build it again today, meaning like buy the land, do all the permits, build it per unit, are you buying it below replacement cost? What does it cost to replace something in that market? And if it costs way crazy numbers amount to replace something, like your replacement cost, and you can buy below replacement cost, there's value there, right? Like I said in that deal, if you're buying 400,000 or $300,000 per unit below what it costs to build it today, that is value. Or and this kind of to me falls along the line of a replacement cost, also below last trade. Let's say in that deal, I looked at a deal the other day too. We made a run at that deal. Someone just bought a deal, 230 units for 120 million. That's what they just bought for 3 years ago. And now it's probably going to trade for around 90 million. That's what they were asking for this asset. That's a $30 million discount below what it sold for. And I know this property, it would cost somewhere around, it would probably cost somewhere around 600 to $700,000 to rebuild that specific property or more. So you have 2 points that we're looking at when we're underwriting a deal. Is it below replacement cost? And number two, are we able to maybe get it for below what it traded at last, what they paid for it? Those are two things I'm looking at when we're underwriting a deal. Next, cash flow. Number one thing on any deal, it has to cash flow. All these, like, I know some people are developers. There's no cash flow in that. Some people make a lot of money at it. I believe builders go broke. I know a lot of builders, my buddies, they'll buy stuff, hold on to stuff, they lose the project, and then they go on to the next one. Like, I like cash flow. Your cash flow should pay your debt and it should pay your investors. That's number one. So the day one you look at any deal, we're looking at a deal when you're underwriting, it has to cash flow. The income, minus the expenses has to also cover the debt. And that's what positive cash flow is. So it has to be positive cash flow. Year one, day one, year one has to work. And it needs to be stable. That's another thing too. Like the lender wants to see if you're going to buy a deal and you're going to take it to you're going to get financing for it. The lender wants to know that it's been stabilized. 12 months is better than 90 days, but they want to see the last 90 days where it sits at. For you to even get financing, it has to have cash flow for the last 90 days minimum, or it's not going to get financed, whatever. You need to know that because sometimes you'll have an investor, you have an owner that may say, "Hey, we're coming to market on this deal." They start padding the numbers. They start pushing the rents, getting it, and it's cash flowing when you see it, but it may not have been cash flowing for a long time. So that's important when I'm looking at any deal. I'm like, hey, I want to see that it cash flows, and I want to see that it cash flows for the last 90 days minimum. It's called you want the T12, and then it goes into like the last 90 day, the T3s. I'll go over that later. There's other videos on the channel for that. Right? Stick with me, man. I know it's a lot. I'm talking fast, but I'll walk through these important stuff later. I'll do it on a separate paper. Then you have your back of napkin underwriting, which I will do that. I will do this. So this is the same math all the time. And I'm going to deal with this as if we're looking at a medium-sized deal or a small deal. Let's say we're looking at a 10 or 20 unit deal. But this is the same if you're looking at a 10 unit deal, 100 unit deal, or 200 unit, 500 unit, doesn't matter. You're going to look at the rental income, right? Whatever that number is, minus expenses, right? And in this rental income, your income of the property, it could be rental income times the number of units, whatever, minus your expenses of the specific property, right? That is going to be your NOI, your net operating income. This is probably the most, not probably, this is the most important number when you're underwriting a deal. This decides how much debt the property can take on. This decides what the value of the property is. This decides what somebody else is going to be willing to pay for it later, whether it's a good deal or not. The NOI is most important, but it's your income minus your expenses equals your NOI. All right, that's the back of napkin math. Now, if you want to find out the value of the property, then you would take that NOI, you would divide it by what's called a cap rate. What's called a cap rate. Basically, that is the return that you would be expecting on that property if you paid all cash for it, right? There's different ways to say it. It's the return you can expect. And that's based on the market. That's based on you, what you want, and it's also based on what the market will say. So like it's complicated, but it's not. Like just picture this. Every market has a different cap rate. Every property based on whether somebody thinks they should get more money from that property because it's more risky, they'll be like, yeah, I want a higher return. So that would say like San Diego's cap rates right now, they're trading somewhere around 4.75 to 5.5. You may be in Georgia and your cap rate may be 6.5 to 7, depending on the deal, or maybe 5. I don't know. Maybe in Arizona and Florida, Scottsdale, you may find a deal that's trading at 4.75, 4, 5. If it's a better property, maybe at 4.75, 4.5. So you're going to have to play with this, and this is easy. Just Google or go to chat or whatever and be like, hey, what's the market cap rate in San Diego? What's the market cap rate in Hawaii, Honolulu, Hawaii? What's the market cap rate in Miami, Florida? What's the market cap rate in Jacksonville, Florida? What's the market cap rate in like Michigan, right? In like Flint, Michigan, wherever you are, Indiana, Indianapolis, Utah. Like you can find this information out. But this, when you're doing your back of napkin underwriting, this is what you need to find out. Now, I left something off of here. You want to have minus your vacancy. I wanted to keep it simple because I got other videos where we break this down. So you would do your rent, your total rents minus your vacancy. And in most properties, they're going to say, oh, we're 100% full. Doesn't really happen. Like the bank isn't going to let you say you're 100% full ever. They're always going to have what's called a vacancy rate or vacancy factor. We'll go over that in another video. So you have your rental income minus vacancies. So let's say it's 5%. So you'd be like, we're 95% occupied or 5% vacant. If you have a fourplex and somebody goes, let's say you're looking at a 4 unit building as multifamily, and you shouldn't, but let's say you are. And somebody goes, yeah, we're 10% vacant. We have a 10% vacancy. There's no 10% vacancy in 4 units. If you're 1 unit vacant, that's a 25% vacancy. And really, the bank still looks at that as residential. 5 units or above are considered commercial of the loan, right? Because you're buying a business here. 5 units and above is more commercial loan. 4 units and below are residential. So you're still kind of getting like a home loan. Anyways, not to be confusing, don't be confused, play this back. But the basic back of napkin underwriting, you're going to do your gross income or your rental income of the property minus your vacancies, whatever that is. You can use 10% or 5%. Just put something there. You're going to always have it in any deal. And if they tell you it's higher, like someone sent me a deal this morning, they were like, hey, we're looking at this deal, but the vacancy is 15% in that market. So don't make it up. Use 15% minus the expenses on the property, and then that gives you your NOI, which is what we're always looking for because your NOI is going to determine how much debt, which we'll go over. And if you want to find out the value of the property, you're going to take your NOI divided by your cap rate, and that's what it'll give you. All right. So I'm going to give you an example of that because I went through that pretty quickly. We'll use a 100 unit deal, back of napkin math. So let's say we have a 100 unit deal and the rents are $2,000 a month. So 2,000 times 100 units gives you $200,000. Can you guys see that? Boom. And everything in multifamily is done by annual basis. So that means that the income of this property is $2.4 million minus, let's say on this deal, minus 5% for vacancies. That brings it down to 2.28, right? And then we're going to, usually there's other income. We're just going to leave that off for now. I'll go over that in more detail in another video. Minus, let's say the market we're in says 40% for expenses right here. So we're just going to use a factor of 40% on the expenses. That leaves an NOI of 1.368 million. And let's say the market we're in, which let's say a six cap. You're going to take 1.368, divide that by 6% on a cap rate, gives us a value for that property at $22 million. And like we said, we want to figure out per price per unit. We'll go over that later. I usually do this. It's just second nature to me. I divide that by however many units we have, and that means we will be buying that property for $228,000 a door. Sounds like a good deal, man, if the rent's at 2,000. But anyways, that's how you come up with the back of napkin math for your underwriting. I know this is going long. Stick with me, man. We're gonna get it. Wrong page. But that is how we figure out back of napkin math, right? Income minus expenses equals your NOI. You divide that by your cap rate. And I put it there, don't forget vacancy, because I do. So for these videos I do, but never in real life. So next thing, and this is important, which is why I wanted to show you that first, is because once you have your NOI, now the next thing you're going to be doing when you underwrite is you want to get a debt calculation. So this is probably the number one, which is why it starred 2 times, the most important thing when you're underwriting multifamily real estate, because all multifamily real estate, if you're like 5 units commercial property, is controlled by the debt. And I want to share this with you and show this to you guys so you get it. If you get nothing else from this video, make sure you get this. As it relates to the debt in real estate, the debt goes like this, right? So your debt, it'll go up and it'll come down. It'll go up, it'll come down. That's the debt. Now the value, if the debt goes up, right? If your interest rate goes up, the value comes down. The value of your real estate comes down, right? If the value of your debt, like the interest rate on your debt is down, the value of your real estate goes up because they're inverted, right? So if the interest rate comes down, value goes up. If your interest rate goes up, value of the property comes down because there's less buyers to borrow. It basically is called we call it the cost of capital. The cost of your money goes up, so it costs more to buy something. The value, people are going to be willing to pay less of a return on that money because it costs them more to buy it. So that's why this is so important. The other thing, which is why this is important, because your debt is your debt and your financing, your banker, Fannie, Freddie, a life insurance company, wherever you're getting your financing from, they are the number one business partner you have. So in a real estate deal, let's say we'll use the last deal. Let's say we bought that deal. Let's say we bought that deal for $20 million. I'm getting ready to write 60 because I usually do bigger deals. So this deal, which is why I was going with the 60, is 60% of that is going to be raised. Like if you had to go raise $20 million, you're not like me. I don't have $20 million ever. I'm gonna have to go raise the money. My first raise is always going to be I'm going to go find whoever does multifamily real estate in San Diego County that loves this specific deal, Class B, great looking asset, great location, because I'm a location junkie. And I'm going to find somebody and they're going to be like, yeah, man, we love that deal. We'd love to give you 60% of the 20 million. They're going to give me $12 million of the 20 million. That's why this is so important. But they're only going to lend that money, the 60 million. I mean, I'm sorry, the 60 million. I keep having 60 million in my mind. That must means we're going to get a $60 million deal. The 20 million, the 60%, the 60% that they're going to give us of the 20 million, the $12 million, they're only doing that based on the NOI, which is why I showed you guys. You got to kind of underwrite the deal so you know what the NOI is, so you know how much debt that property can support. And then you can say, hey guys, look, this is the NOI. This is the price that I came up with. How much will you give me? And then they're going to say, based on the NOI, we will give you $12 million, hypothetically. So, like, that's how this works. That's why, first, you got to know the debt. Never over leverage. There's a couple of nevers on here. Never, never over leverage. Leverage. Never over leverage your deal. There's a never in debt. You see all these guys are like, oh, the market crashed in 2008 and people are upside down. That's because they had too much debt. And as the interest rates rose, their value came down, and that's where the problem happens. So for us, I never look at a deal like they'll sometimes lenders will be like, we'll give you 80%. Man, never take that bet. Never, never, never. You'll always regret it. It's gonna be, man, maybe we could do it. Maybe go 75, 73%. If you're on a refinance, you can do that, 72%. But most of them won't want to do it. The bigger, the better your deal. They will lend less money and you won't need it. You want to get good debt, but never over leverage. That is a never. So if they're going to give you 60%, you're at $12 million on a deal. Now you already know all you got to do is raise the other $8 million. Now you just go to your friends, your network, your family, people like me. I do it. I've been raising money. I've been raising this money from debt, financing, and partners my whole life. This is the game if you're going to do real estate. But you don't know how much you have to raise until you already raised the first part, which is the 60. Now you just put in the other 40%. That's how this game works. But the debt part is so valuable. So valuable. But like I said, never over leverage. Stick to the 60, but that's how that's done. Where we're at. Oh, the other thing, less LTV. That's 60%. Never. These are rules, don't break them. Never over leverage. You want to stick to less debt on a deal, 60/40. And you also want to lock in the actual rate. The longer you can lock in your rate, the better, right? So, like, if you can, like, debt is usually done for, they may do a 30-year term, or if you're in Canada, they'll do a 50-year term, like annual amortization. They'll spread the loan out. They'll lend extended, but it's due in 3, 5, 7, 10, and I think a few years back they did like some 12-year loan. I think they took that away. But just know that they're going to be like, hey, we're going to amortize it over 30 years or 25 years or 35 years, depending on the deal or the lender. But it's due in 3, 5, 7, 10 years, period. You want to lock that in. If you can lock in a rate and you can lock in a good term, 5 years or 10 years, the longer the better. Those are rules. One, less, don't over leverage. Two, lock it in if you can. Those are rules with debt. Period. End of story. Most people who look at our deals are like, oh, what are your fees? And what they should really be asking us is, what is the debt? How does the debt look? Is it 5 years, 7 years, 10 years? Is it interest only? Is it fixed? Like, that is probably the most important, because the biggest part about this is debt makes people lose deals, not the other way around. The deal is never the problem. The debt turns into a problem. So the next thing is scale. When we're underwriting, the number of units is the most important number in real estate. Finance, it's NOI, but real estate itself is the number of units. One door, just say no more, man. Just like, look, I know your financial advisor and all your family and friends are gonna be like, let's buy a house and flip it. Let me tell you, that is a problem. My first deal, we had 24 properties that first year when I bought them. One single family house. That was the only headache in that portfolio. We sold that one off, spun it off really quick, Everything else we kept for a while. So the number of units is the most important number in real estate. And here's why, is because I didn't go through, well, and I do have it here and I'll go through it in a minute. So let's say you have that same 100 unit deal that we talked about for 2000. Let's say you raise the rents by $200 a month times 100 units is 20,000 for the month. So you've increased the income of that property by $20,000 a month. Not a lot, but if you times that by 12, like we said, 2.4 million. And what did we use? We use a 6% cap rate on that deal, right? We've increased the value of the property by $4 million. That's 4 million. You made $4 million because you increased the value over 100 doors. That's different. So let's say you did that with, I don't know, with a single family house, you can't do it. You got one unit. So that like one unit as a rental, if you raise the rents, it doesn't matter because the value of your property is based on your neighbor selling their property. It's a sold comp. It can't just be like, oh, I'll put my house on the market. Yeah, but it never sold. What's the last thing that sold around you? Oh, that one sold for 500. Okay, well now we got to bridge the gap between it. There's no thing, but in multifamily real estate, the number of units is the most important number. Why? Because if you were to increase the rents by $200 on 100 units, or let's just do that same thing. And so you can get what I'm saying here. Let's say we only increase the rents on 100 units by $50 times 100 units, $5,000 only. No one's going to move for $50 if you increase the rents across your portfolio. And we're just saying we get it. I'll leave out the expenses, all that stuff, but times 12 months, that's $60,000 in increased income. You didn't have to do anything. They're still paying what they paid before. You're just increasing it. Let's say it took you 12 months to do that. Divide that by the same 6% cap rate. You made $1 million by increasing the income, the rents of the property by $50. That's it. You even if you increased it by like we just showed you, $50, $100, that'd been 2 million. So that is why the scale matters. The number of units is the most important number in real estate if you're doing multifamily real estate. Period. End of story. Why? Because it gives you that big bang, which leads us to exits. You need to have an exit. um, and I just went over the $1 million math. I'll go over the $1 million math method in a minute. Where am I at? All right, so you need to have three exits for me. Exits. Exits. I have multiple exits, period. You got to know what your exits are, right? Because this is what you're going to tell your investors. This is how you talk to your investors, your lender, your banks. So, like, number one, there's a couple different ways that you're going to exit your deal. You can sell it. Selling it is one way to exit a deal. Now, the problem with selling an asset is you got to do it again, right? So you're going to do it, you're going to make your money, you're going to exit, and you're going to sell. That's one way. You can refi, you can refinance it. Boom, you can refinance it. Now, there's a couple of refis. You can refinance it and drop the rate. You can bring the rate down because I've done that. I had a deal. We had a deal. We got in. We stabilized the property. We went back, refinanced it, and all we did was drop the rate. We didn't take any money out. And the lenders were like, cool, new rate, new this. We did whatever we did. Next exit, we can do a refi cash out. This is the one everyone likes because on this one, there is no taxes on that, right? Because you're refinancing it. You're going to take out money that you had in it, your equity or your down payment, you and your investors, and you're going to give them that back. Non-taxable event if you're not selling, and then you're going to keep the property because you still own it. And you're going to cash out. You're going to take out money from the asset. Money you had as a down payment and maybe some of your profit, depending on the deal, right? So like this is another exit, or which this could be called an exit, no exit, which a lot of people say, but it's ultimately a refi cash out or a cash out refi. And there's another thing too. If you're a big boy, you can do this. It's called a recap. Recap. So in boom, that's a recap. So what happens on a recap is let's say you have one group of investors and let's say you bought a I don't know 50 unit apartment building. You have investors, it's friends and family. They want out, right? And this is like I said, usually done for big boys. You'll have a group like Bell Capital, and we'll say, hey, we have our retail investors, and we're going to go to now a family office, and we're selling the property. because we're getting new LPs. So we're recapping the property, recapping the LPs out. So we're going to buy out our limited partnership, and then now we're going to sell the property to ourselves again with this new group of investors that are going to stay in the deal for another 10 years because we love the property. New property, we're recapitalizing the property, taking out our old investor, our LPs, and now we're bringing in new LPs. All of our old LPs are going to be moving on. They're excited about it. Some will stay, some will go, whatever. But that's called a recap. What's another one? You could, how much paper do I have left? I know this is long. Another exit is you could bundle, right? You can sell a portfolio. That's another one. You can take because I did this. We had two properties in one location, one area that we were managing. So we took a 10 unit and a 12 unit and we put them on one spreadsheet and we were like, hey, you can buy a portfolio or you can buy them individually. Somebody actually bought one, later came back, bought the other one. So that's a portfolio. You can bundle them up, but that's still an exit. Why? Because if you have a portfolio sale, let's say it doesn't matter if you have 10, 20 unit deals that are 100 units. You have 500 unit properties. This is how Blackstone and KKR and Starwood Capital and Equity Residential, this is how they exit deals. They have to. And other people who buy deals have to buy them in a portfolio because they can't go buy a 100 unit deal. That's not how it works. They have too much capital sitting. So they got to buy a portfolio, right? They got to go in and say, look, we'll buy all 11,000 units all at one time, one closing, one document, one everything. And that's what they do. It's a suite, but you can do that because, and you want to do that if you're going to do it, because you can do it and you'll get a premium per unit. People will pay more money for a portfolio of assets that are performing than they will for an individual asset at one time because the cost of doing one at a time just sucks. All right. Let's see. What's another one? You can actually, you can buy the management, which we plan on doing. We can buy the management company and then sell portions, sell a percent. So let's say we bought our, let's say we have the same portfolio, they have their own asset management firm. We buy the actual REIT. We can buy the REIT and then you take it private. You can exit like that. So let's say you can be like, hey, look, we have the property, we're gonna bundle them all up, or we're going to go public and sell it off as a REIT, and then somebody else can go from private to public or public to private. However you want to do this, because I want to give you different ideas because I have a private equity firm, so I kind of talk differently. And I'm sorry if it's confusing, but in my head, I'm like, hey, we're gonna need to bundle this up as a portfolio, take it to market, rip someone's head off at closing, some firm, some private equity place, or we're going to be like, hey, look, we're going to actually build a property management company. We're going to sell off a portion of that, and then underneath our properties that we control, we're going to roll those up, go public as a REIT, and then later they can come back out and buy us and take us private again. Like these are things that I think about because I want it. I want it. But I brought all this up to say this is how you underwrite a deal. Number one, you got to be, hey, what are the barriers to entry? You got to know that going in the door. Do your research, do your study, get with a guy like me, whatever. Keep watching my channel. I'm here for you. Next, what are the replacement costs? Right? Like how much does it cost to build in that market? And if it's below replacement cost, can we buy it below replacement cost? And maybe we can buy for below what it last traded for, which is another version of below replacement cost. Next, does it cash flow day one? We got to make sure it cash flows. This is the game. It should be on my forehead. But and then next, when you're underwriting, you want to underwrite. You want back of napkin math, expenses minus vacancy. I mean, I'm sorry, the income minus the vacancy minus the expenses divided by the cap rate gives you your NOI. So now you know what the value of the property is quickly, so you can continue to have the conversation with brokers. Next, you need to know what the debt is. What are your debt calculations? 60%, 40% loan to value, meaning like the lender's gonna lend you 60% or give you 60% of the purchase price. Will you be able to, one, get the right loan to value, right, the LTV, and can you lock the rate in? You need to know that. What's going to be the calculations you're going to use as you're looking at debt and financing for your deal when you're underwriting? Next, is there enough scale for you to make enough money for you and your investors? That's probably the most important thing. Can we make money for ourselves and our investors as a group, or if you're buying this for you and your family, like, can you keep the deal? Are there enough units whereas if you lose one or two tenants, it doesn't affect you? Or let's say you're in a 200 unit apartment building and 20 people move out, that's a 10% vacancy. You can still pay your bills. You can still pay the debt. You can still pay your investors. It'll get tight. You're going to have to kind of like crack the whip on your management company. But but that's what matters because you have scale, you can weather any economic storms for long periods of time. And then last but not least, how are you going to get out? I already went over the $1 million math. That was the increase in the $200 rent. How are you going to get out of this thing? You need multiple exits. Who's going to buy it from you later? Who's your buyer? Is it going to like I said, is it a private equity firm, family office? Is it a doctor, a dentist in your local market? Is it a mom and pop shop? Is it your neighbor? Maybe you bought a 10 unit building and the people next to you own a 10 unit building and you're like, hey, could you buy this thing? Next, what's the debt? We talked about it in the debt thing. Did I draw it on here? I know I did. Um, what's the debt? Is the debt going up and down? Is this it? Nah. Hold on, guys. Hold on, man. Hold on. I drew so much, didn't I? Anyways, I drew that graph going up and down. Is like when you sell this thing, when it exits, how much debt can they get on this property? Could they get 60% worth of debt on this property again? What's available at the time? You don't know, but you need to kind of know. And then last but not least, what are the rates going to be? Now, that's the one thing you can't find out. You don't know what the rates are going to be 7, 10, 20 years from now, but you need to underwrite your deal. Say, hey, what if the interest rates went up? What if they came down? What if the interest rates and the cap rate, which is what I have right here, cap rate and the interest rate? What if I bought it at a six cap and the interest rates went up and I got to sell it at a seven or an eight? How much equity is there or how much profit is there? Because later when my buyer comes, who the buyer is, how much are they going to want in return for their money when they buy the property from us at the time? And if that's not the case, if my exes don't work because the market's not friendly, do I have enough units and cash flow and is my debt long enough to weather that economic storm? Because my $1 million math, I may make $10 million, 20 million, 1 million, whatever. But if I can't see the game till the end, I lose the game by default. That's why underwriting is so important. So look, some of this might be confusing. Go back to it. I do talk fast, man. I know, and I apologize. That's why I make videos. So you can like and then run your finger back across that red line on YouTube or wherever you're watching this at, and you can watch it again and you can take notes or you can copy the transcripts and drop them in the chat and be like, what the hell is this guy talking about? Like, I try to do this because I wish I had this. This channel is for one reason alone to help you and your family make millions of dollars using real estate and create wealth for you guys long term. Like, I'm doing this. You can do it with me at Bell Capital. You can go to bell-capital.com. You can hit contact us, schedule a call with myself, someone on my team. Like, there's a lot of work, guys. We find the deals, fund the deals, manage the deals. If you're a limited partner, you don't have to deal with tenants, toilets, termites, taxes, none of that crap. We handle all of it for you. You invest money and then you get money back. You get a check, but you also are a partner in the deal without the headaches. We do this. That's why we have a team. So I said all that to say, if you want to do something with us, go to bell-capital.com, or if you want to do this yourself, I'm here to help you guys. You can come to an event that we do. You can keep watching this channel for free. We do this totally for free. Costs you nothing to show up and listen and learn. Or you can reach out to us. Either way, we're here to help. All right. Because we got a real estate club too. You can text 760-531-8500. Text club. Someone on my team will get back to you and share with you the information to be able to join our real estate club so we can help you do your own deals if that's what you want to do. All right. So I hope that helps. I really do. I wanted to do this. Man, it went all over the place, but you know what? Like I said, there's a lot to learn here, but it's not rocket science. It's not. I'm not Elon. I'm not going to, well, he's not even going to Mars anymore. Right now, we're going to the moon. I didn't build a rocket ship to go to the moon, but what I did do was build a rocket ship to get to millions, man. Let's go. That's what I want to do for you guys. I want to help you guys. If you want to invest, you want to be a limited partner, join what we're doing in our real estate fund. You got to be accredited. You got to have a good attitude. You got to think long term. Got to love the idea of real estate, cash flow, appreciation, tax benefits, and trust. Can't be a dickhead who don't trust or a jackass. I know I shouldn't say that, but it is what it is. So I got to run. I appreciate you guys heading over to my office. But let us know if you need anything. Let me leave something in the comments here. What did you take away from this? Am I crazy? Are you looking at a deal and any of this stuff right here, the deal you're looking at doesn't hit this thing? Let me know in the comments and how I can help you guys. I'm here for you for that. I want to talk back and forth to you guys, not just talk at you. I want to talk with you. This should be a two-way thing, but I'm here for you. Let me know how I can help. Let's get after it today. Boom.